Starting an investment journey can feel intimidating, especially when you're working with limited funds. But here's the truth that many beginners don't realize. You don't need thousands of dollars to begin building wealth through investing. In fact, with just $100, you can take your first real step toward financial independence. This guide will walk you through everything you need to know to start investing with exactly $100. We'll break it down into simple, actionable steps that you can follow today. The first thing you need to understand is why investing matters at all. Money sitting in a regular savings account earns almost nothing these days. Most savings accounts offer interest rates below 1% per year, which means your money is actually losing purchasing power due to inflation. When you invest, you're putting your money into assets that have the potential to grow significantly over time. Even starting with $100 allows you to tap into this growth potential immediately. The power of compound returns means that your money can multiply as your investments earn returns. And those returns earn returns on themselves. Before you invest a single dollar, you need to understand your personal financial situation. Take a close look at your monthly expenses and your income. Do you have an emergency fund with 3 to 6 months of expenses saved? If not, you should build that first before investing aggressively. An emergency fund protects you from being forced to sell your investments at a loss when unexpected expenses arise. However, if you already have some emergency savings in place, you're ready to start investing. Even with $100, you can begin your journey while simultaneously building your emergency fund. Now let's talk about the different investment options available to you with $100. The most accessible option for beginners is a stock market index fund or exchange-traded fund, often called an ETF. These investments allow you to buy a small piece of many different companies with a single purchase. For example, you could invest in a fund that tracks the entire stock market, or a fund focused on large companies. ETFs are perfect for beginners because they provide instant diversification, which means your risk is spread across many different investments rather than concentrated in a single stock. Another excellent option for beginners is a fractional share platform. These modern investment apps allow you to buy partial shares of individual stocks, which means you can invest in expensive companies like those famous tech corporations without needing thousands of dollars. With $100, you could own small pieces of 10 different companies, or focus on owning larger fractional shares of 5 companies that you believe in. This flexibility is one of the biggest advantages of modern investing technology. You should also consider robo-advisors, which are automated investment services designed specifically for people like you. When you deposit your money with a robo-advisor, you answer a few simple questions about your age, goals, and risk tolerance. The robo-advisor then automatically invests your money in a diversified portfolio of ETFs that matches your profile. Many robo-advisors have low or zero minimum investment requirements, making them perfect for starting with $100. They'll also automatically rebalance your portfolio, which means you don't have to think about managing your investments. Let's walk through the step-by-step process of actually making your first investment. Step 1 is choosing your investment platform. You have many options to consider. Online brokerages like major financial institutions offer low-cost investing with zero commission trades. Robo-advisor platforms automate the entire process for you. Investment apps focused on fractional shares make it simple to buy pieces of individual stocks. Each option has advantages, so choose based on what appeals to you most. If you want simplicity and automation, go with a robo-advisor. If you want more control over individual investments, choose a brokerage or fractional share app. Step 2 is opening an account and verifying your identity. You'll need to provide some basic personal information like your name, address, and social security number. This process is secure and required by law. Most platforms have you complete this verification within a few minutes using their mobile app or website. You might need to provide a photo of your driver's license or passport. Once your identity is verified, you're typically approved to start investing within 24 hours. Step 3 is funding your account with your $100. You can transfer money from your bank account through an electronic bank transfer, which usually takes 3 to 5 business days. Some platforms also accept credit or debit card deposits, though these might be slower. Once your money appears in your investment account, it's ready to deploy. Don't feel pressured to invest it all immediately. If you're nervous, you could invest $50 now and $50 next month. Taking it slowly helps you build confidence in the process. Step 4 is actually making your first investment. If you're using a robo-advisor, you just approve their recommendation, and your money is automatically invested according to your risk profile. If you're using a brokerage, you'll search for an ETF or fractional shares you want to buy, review the details, and confirm the purchase. The whole process takes less than 2 minutes. After this step, you'll officially own investments. Congratulations, you're now an investor. Step 5 is setting up automatic monthly contributions if possible. Even if it's just $20 or $30 per month, regular investing is one of the most powerful wealth-building habits you can develop. This practice is called dollar cost averaging, and it removes emotion from your investing decisions. You're investing the same amount regardless of whether the market is up or down, which naturally forces you to buy more shares when prices are low and fewer shares when prices are high. Over decades, this approach dramatically improves your returns. Now, let's discuss something crucial: managing your emotions as an investor. When you check your investment account after a week, you might see the value has gone down by $5 or $10. This is completely normal and expected. Stock markets fluctuate constantly based on news, economic reports, and investor sentiment. If you panic and sell when the value drops, you lock in losses and miss the recovery that almost always follows. The investors who become wealthy are those who stay calm during volatility and remember their long-term goals. Your $100 investment is the beginning of a journey that should span decades, not months. One of the biggest mistakes beginners make is trying to pick individual stocks and beat the market. They read about a company and think they've found the next big opportunity. Professional investors with teams of analysts struggle to consistently beat the market, so an individual investor with $100 certainly can't either. Instead, focus on low-cost, diversified index funds and ETFs. These might not sound exciting, but they're the path that has made more millionaires than any other strategy. Let's talk about fees, which can quietly destroy your returns if you're not careful. Some investment platforms charge commissions for buying and selling stocks. Others charge annual management fees that eat into your gains. When you're starting with $100, even a small fee becomes a significant percentage of your investment. Always choose platforms that charge zero commission trades and minimal management fees. Many modern platforms charge less than 0.3% annually, which means you keep more of your returns. You should understand the different types of investment accounts available to you. A regular taxable investment account is straightforward, but you'll pay taxes on any gains when you sell. A Roth IRA is a retirement account where your money grows tax-free forever, and withdrawals in retirement are completely tax-free. With a Roth IRA, you can invest up to $7,000 per year, though you might want to check current limits. Even with $100, opening a Roth IRA is a fantastic decision because that money will have decades to grow tax-free. Security is another critical concern when starting to invest online. Make sure you're using secure passwords that you don't reuse across multiple websites. Enable two-factor authentication on your account whenever possible. This adds an extra layer of protection where you need to confirm your identity through your phone or email when logging in from a new device. Never share your login credentials with anyone, and be suspicious of emails asking you to verify your account information. Real investment platforms never ask for passwords through email. Let's discuss realistic expectations for your returns. The stock market has returned approximately 10% per year on average over the past century, though some years are much higher and others are negative. With $100, if you earn 10% per year, you'll make $10 in the first year. That might not sound exciting, but remember that you're learning the process while building the habit. More importantly, as you add more money through monthly contributions and earn returns on your growing balance, that 10% applies to increasingly larger amounts. After $100, you should think about how to scale your investing. If your goal is to reach $1,000, you need to add money regularly or earn returns through growth. If you contribute $20 monthly and your investments grow 10% yearly, you'll reach $1,000 in approximately 3.5 years. Every dollar you add accelerates this timeline. The key is to start the process and maintain it consistently. Building wealth through investing isn't about making quick, dramatic moves. It's about showing up regularly, staying disciplined, and letting compound growth work its magic over time. One question many beginners ask is whether they should wait for a market downturn before investing. This is a mistake. Trying to time the market perfectly is virtually impossible, and waiting for the perfect moment costs you valuable time. Even if the market drops significantly after you invest your $100, you have decades to recover and benefit from the bounce back. In the meantime, you're learning and building the habit. A market drop is actually an opportunity for you to buy more investments at lower prices through your monthly contributions. You should also understand the concept of risk tolerance. This refers to how much volatility you can handle emotionally without making poor decisions. A young person with 40 years until retirement can handle more risk because they have time to recover from downturns. Someone near retirement might prefer safer, more stable investments. When you're starting with $100 as a beginner, you likely have a long time horizon ahead, which means you can handle more risk and invest more aggressively in stocks. As you get older, or closer to using this money, you might shift toward more conservative investments. Diversification is crucial at every level of investing. With $100, you might think you can only own one investment. This used to be true, but modern ETFs and robo-advisors solve this problem beautifully. A single ETF might give you exposure to 500 different companies across various industries and countries. A robo-advisor invests your money across multiple ETF categories automatically. This diversification means that even if one industry struggles, your overall portfolio is protected by strength in other areas. Let's talk about the importance of keeping your investment costs low. If you're investing with a robo-advisor that charges 0.5% in annual fees, that's double or triple what you pay with a low-cost ETF at a discount brokerage. Over decades, that small difference compounds into a massive amount. With $100, if you save 0.2% in fees by choosing wisely, that's just 20 cents initially. But as your balance grows to $10,000, you're saving $20 per year in fees. That's $20 that stays invested and compounds rather than going to fees. Now let's address one of the biggest psychological barriers for new investors: imposter syndrome. You might think that investing is only for rich people or financial experts. This is absolutely false. Investing is for everyone, and in fact, it's more important for people starting with modest amounts because they need compound growth more than anyone else. The wealthy don't stay wealthy by trying to beat the market with complicated strategies. They stay wealthy by investing consistently in diversified low-cost portfolios and leaving the money alone to grow. You're following the same playbook that creates and preserves wealth. Your first $100 is more important psychologically than financially. Yes, it might grow to $110 in your first year. But more importantly, you've established yourself as an investor. You've overcome the initial fear and taken action. Once you think of yourself as an investor, it becomes natural to add more money each month, research investments during your spare time, and make financial decisions based on long-term wealth building rather than short-term consumption. That psychological shift is worth far more than the initial $10 of returns. Let's talk about what to do if you lose money on your first investment. This will happen at some point, and it's important to prepare mentally. Let's say you invest your $100 today, and next week the market drops 5%. Your account now shows $95. This is completely normal and expected. Professional investors experience much larger swings regularly. The key is understanding that this is temporary volatility, not a permanent loss. You only lock in losses when you sell, so you should never panic sell. Instead, view the drop as an opportunity. If you were planning to add $50 next month anyway, that drop actually makes your next purchase more valuable because you're buying at lower prices. You should also understand the difference between investing and speculating. Investing means putting money into assets you believe will grow over years or decades based on fundamental value. Speculating means trying to predict short-term price movements and profit from timing. With $100 and a long time horizon, you should focus entirely on investing. Don't try to speculate about whether a stock will go up or down next week. Don't chase hot tips from friends or social media. Stick to diversified, low-cost investments and give them time to work. Another important aspect of starting with $100 is understanding the power of patience. If you invested $100 at age 25, let it grow with regular contributions, and checked on it at age 65, you'd likely have well over $1 million, assuming even modest returns. This isn't magic or gambling, it's simply the mathematical power of compound growth over 40 years. This is why starting early, even with tiny amounts, is so valuable. You're not trying to get rich quick.